Hi, welcome to our last lecture on Chapter 13, and we're going to continue on with our ratio analysis, and we're going to be doing the last group of ratios here, the solvency ratios. Solvency ratios relate to the company's long-run survival, and in particular, the company's ability to repay lenders when debt matures and to make the required interest payments prior to that date of maturity. Now, most ratios, we would say, the higher the better. But there are a few ratios in which you would want to have a lower ratio, and that would include the days to collect and days to sell, which we learned on our last video, and in this chapter or video, our debt to assets ratio. So please make note of that on your chapter summary notes. In our debt to assets ratio, this indicates the proportion of total assets that the creditors finance. Creditors must be paid regardless of how difficult a year the company may have had. The higher this ratio, the riskier is the company's financing strategy. So we want a lower ratio on this one. For our times interest earned ratio, this indicates how many times the company's interest expense was covered by its operating results. A times interest earned ratio indicates whether the company has sufficient net income to cover the company's interest expense. So we start with the net income and then we add back the interest expense and income tax expense, because interest expense is a tax deductible or a tax deduction. So we want to add that back before we determine the amount of net income that's available to cover interest expense. And then we divide by the interest expense, and on this one, the higher the better. So let's take a look at a problem. We're going to be using our worksheet to do problem E13-5. And we're back to Computer Tycoon from the first few problems that we did. This says, according to the Producer Price Index database maintained by the Bureau of Labor Statistics, the average cost of computer equipment fell 3.8% between January and December of 2016. Let's see whether these changes are reflected in the income statement of Computer Tycoon for the year ended December 31st, 2016. So we've got comparative financial statements again, which means more than 1 year, and we always list the most recent year in the closer column, and then further out is the previous year. And they want us to calculate for Computer Tycoon the times interest earned ratio. So we said to do that, we take our net income and we're going to add back the interest expense and our income tax expense. I'm going to abbreviate that so we have room to calculate. And then we divide by our interest expense to find out how many times over we can pay that interest expense using our net income. It's a coverage ratio. So for 2016, we're going to take our net income, we're going to add back our income tax expense, and then we're going to add back our interest expense. So let's see what we have here. 2,500 plus 1,000 plus 500, which is 4,000. We'll divide by 500, and that will give us a ratio of 8 for 2016. I'm going to have to squeeze 2015 up here a bit. Here we'll take 6,025. We're going to add back 5,000, and we'll add back interest expense of 475. That gives us 11,500, and we again divide by interest expense, in this case 475, and that gives us a coverage rate of 24.2 times. So we were much more able to cover interest expense in 2015 than 2016. Our question here is, does Computer Tycoon generate sufficient net income in both years, before interest and taxes, to cover the cost of debt financing? And by debt financing, we really mean interest. And the answer is yes. We could cover our interest expense in both years. Let's do one more problem while we're here, and that's PA 13-5. And you have a problem like this in your homework group where you have to determine which company is more profitable, more liquid, and more solvent. Our problem here says that Coke and Pepsi are well-known international brands. Coca-Cola sells more than $42 billion each year, while annual sales of PepsiCo products exceed $62 billion. Compare the two companies as a potential investment based on the following ratios as reported by CSImarket.com for the 12 months ended September 30th, 2016. So they ask us which company is more profitable, more liquid, and more solvent, and then they give us the ratio analysis. So what we really have to do first is determine which ratios they're talking about here. And then once we can identify which category they fall under, we can answer these questions. So the gross profit percentage and net profit margin. If we look at our chart, both the gross profit percentage and profit margin fall under profitability ratios. So I'm going to put a P next to both of those. How about earnings per share? Earnings per share is also a profitability ratio. How about the inventory turnover? Inventory turnover would be a liquidity ratio. I'll put an L there. How about our current ratio? Current ratio is a liquidity ratio. Debt to assets, well, we just learned that one today. That's a solvency ratio. And our price earnings ratio, along with EPS, the price earnings ratio is a profitability ratio. So we'll put a P there. Now let's take a look at each company and see how each one does as compared to the other. Who has a higher gross profit percentage? Coca-Cola does here. How about net profit margin? Coca-Cola does. How about earnings per share? PepsiCo is higher there. And what about the price earnings ratio? That's almost a tie. They are very close. Coca-Cola has a slight edge on this. When we take a look at earnings per share, we have to remember that earnings per share takes the total common stockholders' equity and divides by the number of common shares outstanding. So the earnings per share can be somewhat manipulated by purchasing back treasury stock. So knowing how a ratio is calculated is important in determining how that affects the company's ratio results. So I would say overall, the company that's more profitable here would be Coca-Cola, because we would have to look more into the EPS if we had that information to be able to determine if the company bought back shares of treasury stock to help influence the earnings per share. Now let's take a look at the liquidity, the company's ability to pay current debts as they become due using current assets. It looks like PepsiCo is much more liquid than Coca-Cola, and in terms of their current ratio, current assets to current liabilities is also higher there. So PepsiCo would be the more liquid. Now, how about solvency? And there's only one ratio here represented, debt to assets. 85% of the company's assets are financed through debt at PepsiCo, whereas 72% of the company's assets are financed through debt for Coca-Cola. So remember, this is a ratio where the lower ratio is the better. So we would say Coca-Cola is more solvent. Before we finish this chapter, I want to remind you that all three types of analysis, horizontal, vertical, and ratio analysis, are important. It's important that you do all three to be able to get a more fully and well-rounded picture of how the company is doing. The other thing we want to consider is this whole issue of whether differences between a competitor's financial ratios might be caused by differences in accounting decisions. As we look at Lowe's, Home Depot, and Builders FirstSource, if you remember back in Chapter 7, whether a company uses FIFO, LIFO, or weighted average as their costing method for their inventory, it could impact their net income. So all the profitability ratios can be impacted by the type of inventory costing method you use. If you remember Chapter 9 with regard to depreciation, if a company uses a different type of depreciation, again, it can affect the bottom line. So sometimes a difference in ratios or just flat out a difference in their net income can be caused by a difference in accounting decisions in terms of the policies they decide to elect. I'd like you to just think about and remember this term, unqualified opinion. When you look at an auditor's report for a company, an unqualified opinion means that the independent auditor has judged that the financial records and statements of the company are presented appropriately and fairly in accordance with GAAP, our generally accepted accounting principles. You may hear this term, and I'd like you to be introduced to that. The remainder of this chapter is a bit of a review with regard to the conceptual framework. We've talked several times about the objective external financial reporting being to provide useful information to external users. What makes that information useful? Well, it should be relevant, important to decision making. It should be a fair representation and faithful representation of the business's operations. Information is useful if you can compare it period to period, if it can be verified and is objective, if it's produced in a timely basis, and if you can more easily understand it. So that forms what we call the conceptual framework for financial accounting and reporting. Now, we've learned most of these concepts here: the unit of measure, separate entity, time period, cost, revenue and expense recognition, but this going concern concept, really we did not spend much time on it. The going concern concept is the belief that any business will be capable of continuing its operations long enough to realize the economic benefits of its assets and to meet its obligations in the normal course of business. If a company judges it is probable that it will be unable to meet its obligations for at least 1 year after the financial statements are issued, it must disclose this information in the financial statement notes. One more principle, the full disclosure principle, and this principle states that financial reports should present all information that is needed to properly interpret the results of the company's business activities. And that concludes Chapter 13 for us. You can move along to your homework now.